Why do highly intelligent people, like doctors and engineers, often make terrible self-destructive investment decisions in the stock market? Take Sir Isaac Newton, one of history's greatest scientific minds, who lost his entire life savings in the South Sea bubble. He famously noted, "I can calculate the motion of heavenly bodies, but I cannot calculate the madness of crowds." Newton's failure reveals a fundamental financial truth. Your investment success is not determined by your high academic IQ. Instead, long-term wealth building is governed by temperament, strict discipline, and maintaining complete emotional control under pressure. In this comprehensive masterclass, we will explore the core reasons why smart investors consistently lose their hard-earned money. We will analyze the three destructive traps of overconfidence, excessive information noise, and overly complex financial structures. And most importantly, we will look at how to protect and grow your wealth through the analytical eyes of a chartered accountant. First, let us examine the psychological paradox of high intelligence when dealing with modern financial markets. Smart, highly trained professionals, such as doctors, corporate lawyers, and engineers, are deeply accustomed to always being right in their fields. Their difficult professions heavily reward deep academic expertise, rigorous analytical processes, and precise, highly controlled execution. So they naturally assume that this same professional intelligence will translate directly into easy gains in the stock market. They mistake the market for a logical equation to be solved, rather than a highly emotional voting machine. This intellectual hubris leads directly to our very first major trap, the danger of overconfidence bias. When smart individuals experience initial success in a bull market, they quickly credit their own brilliant intellect. In doing so, they completely ignore the massive role of luck, macro market cycles, and broad monetary expansions. They begin taking on massive, highly concentrated positions, fully believing they are completely immune to any investment failure. Consequently, they ignore the most basic accounting rules of diversification, asset allocation, and proactive risk management. This brings us to our second critical trap, the modern phenomenon of information overload and market noise. Today's retail investors are constantly bombarded with rapid financial data, breaking news alerts, and endless social media hype. Smart investors love data, so they consume complex technical charts, endless earnings reports, and conflicting expert predictions. However, more information does not equal better decision-making. In fact, it usually creates overwhelming cognitive noise. They fall victim to confirmation bias, actively searching only for data points that support their pre-existing investment thesis. They get utterly lost in the dizzying complexity of real-time feeds, Bloomberg terminals, and flashing ticker boards. By doing so, they completely miss the simple foundational financial truths buried deep within a company's balance sheet. Our third major trap is the tempting allure of over-engineering and highly complex investment strategies. Brilliant minds often despise simple, index-based solutions because they seem far too boring and intellectually unchallenging. They gravitate instead toward highly leveraged options, complex derivatives, and sophisticated, multi-legged hedging strategies. But extreme complexity introduces dangerous, hidden points of failure while draining their capital through exorbitant management fees. As the legendary Warren Buffett wisely notes, investing is simple, but it certainly is not easy. You do not need a PhD to successfully compound wealth. You simply need to avoid making catastrophic, unforced errors. Now, let us discuss the powerful emotional traps that bypass intellect entirely: FOMO and loss aversion. The intense fear of missing out drives otherwise smart people to buy speculative assets at the absolute valuation peak. They watch their neighbors get rich on hype cycles and panic buy into trends they don't actually understand. And when the market inevitably corrects, loss aversion kicks in, causing their decision-making to freeze up completely. They stubbornly refuse to cut losses on declining businesses because selling means admitting intellectual defeat. Alternatively, they panic and sell at the absolute bottom, permanently locking in devastating capital losses. They fail to separate temporary short-term price volatility from permanent structural capital impairment of the business. So how does a professional chartered accountant look at this complex market problem differently? An accountant filters out the noise and focuses on reality, which is written in the 3 financial statements. While others are distracted by daily stock tickers, we systematically analyze the quality and sustainability of reported earnings. We search for a robust margin of safety, buying only when there is a wide gap between intrinsic value and price. We rigorously verify operating cash flow because reported accounting profits can be easily manipulated through creative booking. But true, operating cash flow represents actual cold hard cash flowing into the bank account, which cannot be faked. We closely examine the debt maturity schedule, ensuring the business can survive prolonged economic downturns. We hunt for red flags, like strange inventory surges, aggressive revenue recognition policies, or suspicious related party transactions. By filtering out market hysteria and focusing entirely on objective numbers, we dramatically reduce our investment risk. Successful investing is not about predicting a certain future. It is about preparing for an uncertain one. If you want to win over the long term, stop trying to outsmart the market with complex theories. Instead, focus on the accounting essentials: consistent cash flow, minimal debt, and a large margin of safety. At the end of the day, quiet consistency and patience will always beat brilliant but undisciplined strategies. Build your wealth on solid, verified accounting truths. Thank you for watching, and I will see you next time.